Good afternoon, everyone. Hope you enjoyed your lunch. So, by way of introduction, for those who don't know me, my name is Bobby, and I head the tax department at Regan Van Roy. So, Regan Van Roy is a firm specialized within the tax environment, tax compliance, advisory, due diligence, transfer pricing, training, etc. So, I've got 20 years plus of tax experience, having worked for the tax authorities, uh, big four firms and a mid-tier firm before joining Regan Van Roy. So we have also my colleague Jayesh Ramloll, who is present. He's got 5 years plus of tax experience. He also worked for a big four firm and a mid-tier firm. So let's start with the agenda. So we'll go through the corporate tax return by examining the main business activity, expression of doubt, allocation of income and expenses, the computation of chargeable income regarding the general rule with respect to deduction of expenses, unauthorized deductions, deductions, non-taxable income, and obviously the calculation of tax, the rate, CSR, foreign tax credit, TDS, ABS, COVID-19 levy, penalties, and interest. So just to let you know that we will take all questions at the end of the webinar. And I'm on slide presentation right now, so I can't see the questions if you are going to shoot it right now. So let's move with the slide. So what are the important information that needs to be disclosed for a tax return? And by the way, a tax return should be, a corporate tax return should be submitted within 6 months from the year end. So the BRN, very important. Its account number, the name of the company, obviously, the name of the declarant, the capacity in which the person is acting, the address of the and the principal place of business. The main business activity. This might be a challenging one because experience taking into account the drop-down menu in terms of the rate. Sometimes it might be a headache to choose the business of activity because it does not appear on the list itself. We've got several examples where companies dealing with, for example, exchange dealer, then renting a space, its own building has been classified as a property developer. So this is something very important to identify the right business activity of the company. Now, related party transactions and whether they are carried out at arm's length. This is also very, very important because it is very often that transactions between related parties are not carried out at arm's length. We can refer to the last Supreme Court judgment in audit, so whereby a loan were granted free of interest. So the MRA imposed deemed interest, and this has been validated by the Supreme Court. The next one is the election for the taxation of foreign exchange differences. So when a company is submitting its first corporate tax return, so it should elect which method it will use for the taxation of foreign exchange differences, forex. So the one is the realized basis. So the taxation is on a realized basis. Unrealized gains or losses are not taxed or deducted. And then traditional basis, which does not distinguish between realized and unrealized. Now, you've got also forex, which are classified as capital in nature when it relates to revaluation of bank balances at year end. There is a super which deals with the way that bank revaluation, forex on bank revaluation should be dealt with. Next one is expression of doubt. So sometimes back the MRA has inserted on its corporate tax return expression of doubt. So in case someone has doubt in terms of the interpretation of the tax treatment, so a doubt can be expressed. Just to share with you, with 20 years in the tax space, I have never expressed any doubt on a tax return. Now, yeah. So how income and expenses are allocated? So let's take typically a corp tax return. So you could see the P&L turnover and then 1.1, 1.2, 1.3, 1.4, etc. So the turnover itself is defined in the income tax. There is only one place where turnover is defined. It relates to the solidarity levy on telephony service providers. Otherwise, turnover is not defined. But gross income is defined. Gross income is the aggregate income, aggregate amount of all income other than exempt income. So if we take 1.2, 1.3, and 1.4, so income derived by these categories of companies, tax at 3%, of course, subject to meeting certain conditions. Now, what are the rates? So companies engaged in exports, we've just seen, it's 3%, manufacturing companies, 3%, higher education institutions, 3%. Now, why I am putting these rates? Because you might be having an entity which have both income taxable at 3% and 15%. So all of the companies, it's 15%. So how to distinguish, how to calculate the tax when you've got two types of rates? So there's a formula which should be used to distinguish the 3% from the 15%. It's A over B multiplied by, where A is a gross income derived from the above three activities. B would be the gross income from all activities, and C is the chargeable income of the company for the year. Now, allocation of income and expenses. Again, I've taken an example of a corporate tax return. So you could see dividends. So dividend, you've got two types of dividend. It could be local or it could be foreign. So local dividend are exempt from tax. But foreign dividend is subject to tax and, of course, titled to the 80% exemption, provided certain conditions relating to the substance requirement are met. Now, you've got other types of income you could see in the chapter. So these income are subject to the 80% partial exemption, but of course, subject to conditions being satisfied, especially to the core income generating activities, SIGA. Now, you've got rent. So it's important when filing preparing a tax return before filing to check whether TDS has been retained. The next one is profit on disposal of assets. So the profit itself is considered to be capital in nature unless the company is dealing in selling of assets. Otherwise, what will happen is that we should have a look at the balancing charge or balancing allowance, which should be adjusted in the tax computation. Now, profit on sale of securities, these are exempt Income Tax Act. Let's continue. So you've got wages and salaries. So of course, you've got different rates of PAYE. So while filing the monthly PAYE return, so as you might be aware, so less than 700K, it's 10%. Less than 975K, 12.5%. And greater than 975K, it's 15%. Now, directors' emoluments, this is subject to 15% PAYE directly. You've got entertainment expenses, gift, and donation. So in accordance with Section 26 of the ITA, these are non-allowable. Interest. So the interest, before allowing interest as an expense, reference should be made to Section 819. So there are two conditions. So it should be taxed in the hand. If the interest is, the MRA can refuse deduction, if the interest is not in the hands of a non-resident recipient, and if it's paid within a reasonable period of time. So that's very important. So what is reasonable has not been mentioned in the law, but the authorities tend to accept between 1 to 3 years. Now, expenses. So depreciation, this should be added back in the tax computation, treated as non-allowable in accordance with Section 26 of the ITA. Bad debts. So bad debts, it should be treated as allowable if proved to be irrecoverable, and unrelieved amount can be carried forward and offset against future interest income indefinitely. Now, you've got expenditure incurred by hotels. So there are additional expenditures. So it's 50% more than the initial deduction. Now, let's have a look at the computation of chargeable. So the net profit before tax is not chargeable are certain income and expenses need to be adjusted for tax purposes, right? So the general for deduction of expense, we should refer to section 80, which stipulates that expenditure or loss to the extent it is exclusively incurred in the production of gross income would be deductible. So it's wholly and exclusively incurred in the production of gross income. If you refer to section 17, which relates to employment income, says wholly, exclusively, and necessary. So the test to allow expenses relating to employment income is higher. Now, you've got expenses which are allowable, straightforward, like wages and salaries, stationery, audit fees, rent, etc. Only business expenses can be treated as deductible to the extent it can be shown to the MRA that it has been incurred in accordance with section 18. Now, section 26 is the number of items which are unauthorized. We call it unauthorized deduction. So you can see that if it is of a capital nature, right? If it has been incurred in the production of exempt income, provision, etc., etc. Now, how to calculate the chargeable income? So expenditure in respect of in the production of exempt income should be disallowed. Expenditure to the extent incurred in the production of exempt, as I've said, is not allowed. So what happens when the expenditure have been incurred both for allowable, taxable income and exempt income? Then a formula should be used to add. So this is a formula: capital gains plus exempt income over total income, including capital gains and exempt income, multiplied by the total allowable expenditure, right? So in case the proportion of the exempt income to total gross income is below 10%, then that should not, the expenses should not be disallowed. Now, you would see that I have used capital gains in the formula, which does not appear in the regulations. The reason is that it was the Supreme Court judgment relating to JP Morgan, where, because we don't have capital gains tax in Mauritius, so expenses relating to capital gains should also be disallowed. That's why it should be used in the expenses. Now, deductions, non-taxable or exempt income. So I will run through a list that you might be aware also. So it's dividend receivable from resident companies. These are exempt income, net income from exempt activity, annual allowance, capital capex, gain on disposal. There's 200% allowance for disabled employee and emoluments in rigs, expenditure incurred on artwork, 200% capex incurred on cash for the benefits of employees, etc., etc. So there is a drop-down list, you can have access to that. So 50% in terms of hotel and cleaning, filing fees for arbitration, additional 50%, expenditure incurred by manufacturing companies on products manufactured locally, and then tax losses. So this is the end of the first part of the webinar. I will request my colleague Jayesh to take over. Jayesh, could you please take over?
Yes, thank you very much, Bobby, and thank you for this insight into the webinar. I'm sure that the audience is enjoying this webinar so far. Hello, everyone. So I'll be talking on the next part of the webinar, which is on the annual allowance, still in the deduction section. I hope everyone is seeing me right now. So
yes, Jayesh. Yes.
So yeah, in terms of annual allowance, so Bobby has been talking about all of the deductions that are available. So annual allowance is part of it, an important part. So there are prescribed rates according to the Income Tax Act regulation, where we need to use the correct annual allowance rate to be able to claim that during an income year. So you can see the list of different asset categories on which you can claim annual allowance. So one important consideration is of course, the maximum annual allowance that you can claim, which is the rate, as you can see. The important consideration as well is the base value and the cost, and how you can make distinction between those two. The base value is essentially the tax written down value on which you can claim the annual allowance. So, for example, as you can see, for hotels, it's 30%. So it's 30% for the first year, it's on the cost. And then for the second year onwards, it will be on the tax written down value. So the basis of calculation will be similar to a reducing balance method. And for the cost, you can see commercial premises, 5% on the cost, which is basically a straight line method of using of calculating the annual allowance. So it will be a fixed amount each year until you use the full allowance of the commercial premises. Going down the list, you can see plant and machinery having costs of a base value of 60,000 rupees or less. So on these type of assets, you have a full allowance, so 100% in the year you incur capital expenditure. And for asset costing more than plant and machinery, to be more specific, costing more than 60,000. So you have already a list there, so which is ships for aircrafts to furniture and fittings, and you have the applicable rates, whether it is on the base value or on the cost, as I explained how to calculate this. And you also have improvement on agricultural land for agricultural purposes with 25% on the base value, and research and development 50%. So moving on, the remaining asset categories on which you can claim annual allowance, as you can see, you have full annual allowance on the acquisition of solar energy unit, all the way to acquisition improvements of any other item of capital nature, which is subject to depreciation, which is 5% on the cost. So you have to bear in mind that when you're preparing the tax computation, you can claim the annual allowance up to that rate. So you cannot go beyond. Even if you go beyond, there might be a risk of the MRA triggering a tax assessment. You have to be careful of this. And funnily enough, we have seen situations where the MRA have issued a tax assessment, and Bobby will agree to that. We'll tell you more about that maybe. We have seen situations where even if a client, a taxpayer, has claimed less, let's say than 15%, you can see golf courses there, 15%. Even if you claim 10%, there may be a risk that the MRA challenges that, because according to them, it will be a case of tax planning. So you have to be careful when you're claiming annual allowance, so that not to attract the attention of the MRA.
Yes, Jayesh, if you allow me, so Jayesh was mentioning that it's grace in front of the ARC actually. So you've got one company, a mix of companies have annual allowance like 1% over the years. And then the company was exempt for 10 years. What happened is that the MRA said that this is tax avoidance, section 90. And then they said the annual allowance should have been taken to the maximum amount. Obviously, as tax practitioners, we don't agree. It says the maximum that could be taken. It doesn't say whether someone, for example, for golf courses, the company should take 10, 12, but the maximum is 15%. So as Jayesh mentioned, it should not exceed the 15%, but the law mentioned the maximum amount. But the case is in front of the ARC. Let's see when the judgment would be delivered, and then we can go back to that. Thank you, Jayesh.
Yes, thanks, Bobby. Thanks for that. Next, we move on to the 80% partial exemption. So, which has, I'm sure you're all aware, which has been recently introduced a few years back. This was introduced in an attempt to have a tax harmonization approach in Mauritius between domestic companies and global business companies. Many companies now are using the partial exemption, and before it was a deemed foreign tax credit, but now we have a mixture of domestic and global businesses claiming the partial exemption on certain income streams, and also depending on the activity they are doing and the type of license, and which are subject to certain conditions, which are in the law, mentioned in the law. We have a list of the partial exemption which income are subject to the partial exemption. So you have the interest derived from money through the peer-to-peer lending platform. You also have the foreign source dividend, and you have interest income. Now, for interest income, there are certain companies, however, that cannot claim the partial exemption, and these companies include a bank, non-bank deposit-taking institution, a money changer, a foreign exchange dealer, an insurance company, a leasing company, a company providing factoring, hire purchase facilities, or credit sales facilities. So those companies I just mentioned cannot claim the 80% partial exemption on interest. Now, moving on to the provision of specified financial services, we're referring to the types of licenses under which you can claim the partial exemption. Of course, there are, as Bobby mentioned, there are certain conditions relating to the core income generating activity, the SIGA, which needs to be adhered to so that you can claim the partial exemption for each license type. So these licenses include the collective investment schemes, closed-end funds, CIS manager, CIS administrator, investment advisor or asset manager, and investment dealer. So moving on to leasing of ships, aircrafts, locomotives, trains, including rail leasing. We also have companies from deriving income from reinsurance and reinsurance brokering activities. And 80% partial exemption is also granted to companies deriving income from leasing and provision of international fiber capacity. Here we have to be careful. Leasing only applies to the international fiber capacity. So if a company is engaged into that, you can claim the partial exemption. You can have companies from deriving income from the sale of financing arrangement, asset management of aircraft and spare parts, and related advisory, aviation advisory services can claim the partial exemption. And last but not least, it's the 80% partial exemption on profit attributable to foreign permanent establishment. Moving on to another part of the deduction section, we have the tax losses brought forward from previous year. So in accordance to Section 59 of the Income Tax Act, the company is allowed to claim or carry forward unrelieved tax losses and set off against taxable profits for a maximum period of 5 years before it has to be lapsed. We have a table to show how this works. So the first column, you have the year assessment. The second column, you have tax loss. And the third column, you have the tax loss lapsed. And the last one is a tax loss to be lapsed in which year assessment. So if you take the first row, 2017-18, you see a tax loss of $2,000. It can be lapsed in 2022, 2023, meaning in the current year assessment. So you have 5 years to carry forward that loss. So this is how it works. Carry forward to 1890, 1920, 2021, up to 22-23, and then you see the third column, you lapse it. You have to be careful on how we've seen in the past how tax advisors have lapsed the tax losses, and we've seen they not correctly counted the years and they misinterpreted the law, what it says. But in practice, the MRA uses this approach to lapse a certain loss.
What Jayesh mentioned is to ensure that the losses are carried forward properly, I mean, in the correct year of assessment, and then lapse in the year that it should be. Because in the event the loss has been carried forward in excess, I think we will cover that in the last slide. There are penalties which are imposed on excess losses carried forward. So that I wanted to add that, Jayesh. Thank you.
Thank you, Bobby. So next, it's corporate social responsibility. According to Section 50L of the Income Tax Act, the company is required to set up a CSR fund and pay an equivalent rate at 2% on the preceding year's chargeable income and remit to the MRA. So how do you go about in remitting this amount to the MRA? So 75% it goes directly to the MRA, and 25% is through your own CSR framework. So your own contribution to a specific organization or foundation. This amount that you pay to the MRA can be further reduced by a maximum of 25%, provided that you obtain a prior approval from the National Social Inclusion Foundation. How it works in the return, when filing the return, there's a box there, a specific box that you have to tick yes or no if you have received a prior approval. If you tick yes, you have to make sure that you received the approval, because you may be asked by the MRA whether you have received it or not. So you have to be careful and make sure that you have received the approval before you tick the box yes. And you'll be able to claim the maximum of 25%. CSR is not applicable, however, to a certain type of companies or part of companies doing certain activities within a business, within their core activities. A global business company doesn't have to pay the CSR. A bank, although it's applicable in respect of income derived from non-residents or other global business companies, an integrated resort scheme company, a non-resident societe, foundation, a trust or trustee, or a unit trust scheme, a company issued with a certificate as a freeport operator or private freeport developer under the Freeport Act, in respect of income derived from exports, a company that has elected to pay a presumptive tax in the preceding year. So that slide is on CSR. Next, we move on to foreign tax credit. Here, it's a very delicate part of the corporate tax, because we have seen a number of situations in the past where the MRA pays really close attention to this, and taxpayers, more often than not, surprisingly, they can't furnish the required information to the MRA. Foreign tax credit is very important. You have to be very careful when claiming that in the tax return. So essentially what it is when you suffer tax on an income, on foreign source income, you can claim the tax that you've suffered abroad. You can claim it in Mauritius. Of course, to the extent you have Mauritius tax liability. Of course, if it's more than that, you cannot claim. You cannot claim that amount as a refund. You just lose the excess amount. No credit shall be allowed in respect of a foreign source income where the person has already claimed the partial exemption. For example, if you derive foreign dividend from South Africa, if you have suffered withholding tax on that dividend and you want to claim the withholding tax in Mauritius, you won't be allowed to claim the partial exemption. So it's either one or the other relating to that specific income. Next, this is an extract from the income tax return where you can claim the withholding tax. You have three different types. Actually, you have the withholding tax, you have the underlying tax, and you have something we call the tax sparing credit. The withholding tax, as I mentioned, this is available on all the income streams, as you can see in the table, and any other income that doesn't appear there, you can always put it in other income at the bottom. And the underlying tax is applicable only to dividends, and the tax sparing, again, is applicable on all income streams. Both the underlying and tax sparing credit have specific conditions attached to them. So we'll cover that in the next slide. The underlying tax credit is one area of concern for taxpayers, because they have to be very careful, because the MRA will look at that very closely, and especially if you don't have documentary evidence. Having said that, now we can talk about briefly what it is and how you can claim it in the tax return. So as I mentioned, it applies to a foreign dividend, and the underlying tax means that you can claim the corporate tax paid by the subsidiary, the foreign subsidiary in Mauritius. You cannot go directly and claim the tax that they have paid there. So there's a formula, there's a specific formula. Unfortunately, I haven't included the formula, but it's quite straightforward. You take a proportion of your dividend that you've received from abroad, and you divide it by your profit after tax of this foreign subsidiary. Then you get a proportion. That proportion, you multiply that by the corporate tax paid by the foreign subsidiary. Then the amount that you get, you multiply it again with the percentage shareholding the parent company, Mauritius, has in the subsidiary. So then you'll get the amount of underlying tax that you can claim. The underlying conditions for the underlying tax credit is a company must own at least 5% in the foreign subsidiary. So if you own less than 5%, you cannot claim the underlying tax. As I mentioned at the start, documentary evidence is crucial to avoid tax assessments from the MRA. And in fact, we've had a recent case where the MRA has issued a tax assessment on a company that was claiming underlying tax. And then let me just tell you the tax penalties and the tax liability was over 2 million USD. So you just have an idea how crucial this documentary evidence for underlying tax is. So before claiming the underlying tax, I would urge you, every taxpayer, every management company who prepares tax computation, just to confirm with the client that documentary evidence is there. It's not prescribed in the law, but in practice, the MRA will give you up to 2 years to furnish documentary evidence. So you have enough time. But before claiming the underlying tax, it's very important that you ask the taxpayer, the client, that if they have the documentary evidence. And by documentary evidence, I mean the proof that they have paid tax, corporate tax in the foreign country. And yeah, if possible, you have the receipt to substantiate that, okay, this is how much tax the subsidiary has paid and how much tax upon which I can claim in Mauritius. So that's the underlying foreign tax credit. Next on is the tax sparing credit. What is a tax sparing credit? Well, this is very, very uncommon, and it's not a very a popular method to use because it's very unique situation, unique condition attached to it. Basically, if a foreign company is not paying tax, is exempt from tax from doing some special project, let's say, aiding to the development of the foreign country, then they are benefiting from a tax exemption or tax holiday. Otherwise, if they didn't have benefit from this tax holiday, they would have paid the normal rate. But what the tax sparing credit does for Mauritius companies deriving income from the foreign company, you can claim the actual tax that they would have paid on that income. This is what the tax sparing credit is. But there's a specific condition attached to that. The MRA must be satisfied that the foreign company is promoting some type of industrial, commercial, scientific, educational, or other development in that foreign country, as I mentioned. These conditions need to be satisfied. So that's why it is very uncommon to see the tax sparing credit, or people might not even know about the tax sparing credit. It's something that you can consider going forward, asking the client if they are receiving income from a foreign company that is benefiting from a tax holiday or tax exemption for carrying out certain specific project. So you can ask them about that. So next, we have the tax deducted at source, the TDS. What is the tax deducted at source? As the name suggests, it's this tax which is deducted at source upon payment to when a payer makes a payment to a recipient. In the law, it's mentioned as a payee. The payer has a responsibility to remit, to withhold and remit the tax rate. Sorry, to apply the tax rate and remit the tax to the MRA. And if the annual turnover of the payer exceeds 6 million, then they will have the requirement to do it. Otherwise, they don't have the requirement. The sixth schedule provides a comprehensive list of the payments that attract the TDS. And here's an extract. You have interest payments, royalties payable to residents and non-resident, rent payable to a resident and non-resident as well. You will see non-resident because this is where we go on. We deal more with the international taxation aspect, and payment to providers of services are specified in the fifth schedule. And the fifth schedule, these are the list of service providers to which on which that we have to retain TDS at 5%. But circling back to the non-resident and international taxation aspect, we have to take into consideration the tax treaty between Mauritius and the other country, whether to know where the taxing rights will lie, and whether they are benefiting some of a reduced rate through the tax treaty. You have to bear in mind these as well. So the next part of the TDS table, you can see the applicable rates, all the other payments. On the last 3, 12, 13, and 14, you can see 3%, and these have been recently added through the Finance Act 2022, and these relate to consultants, provider of security services, cleaning services, pest management services, and other ancillary services, and payment made by insurance companies to motor surveyors and mechanics. So 3%, and this was applicable as from the 3rd of October 2022.
For TDS, there are two things that I would like to add from based on your slides. So the first thing is that when TDS are being retained by those who are retaining the TDS, so the company should make sure that the certificates are taken, because if the amounts of TDS are taken as credit and there are no certificates, so this will be disallowed by the MRA. Now the question is whether the other party which have deducted the TDS, whether they have remitted the TDS to the MRA. So if they have not remitted the TDS to the MRA and deduction have been taken, so the MRA would disallow the TDS. This is one thing. The second thing is TDS should be retained when payment are being made, obviously, regarding payments which are subject to TDS. The reason being is that when the MRA makes an inspection which relates to TDS, what they will do is that they would say TDS has not been retained, so you've got to pay that. But at the same time, I mean, in terms of symmetry, the company has already, I mean, the other companies have already declared their tax return and pay taxes. It's like a double count when it comes to TDS. So these two things should be taken into account relating to TDS. Yes, please carry on, Jayesh. Thank you.
Thank you, Bobby. Next slide, we have the advanced payment system, the commonly phrased APS. So this APS system is where income tax falling due in a particular year assessment is paid in advance by filing the APS returns on a quarterly basis. According to Section 50B of the ITA, there's no requirement to furnish such a return, APS return, if your gross income, the company's gross income, is less than, did not exceed 10 million, or it had no chargeable income in the preceding accounting year. You can be in a situation where you have more than 10 million rupees of gross income in a particular year, but you have no chargeable income. Then you won't have the requirement to file an APS return. Next, a company may choose to file its APS return under either method A or method B. So method A is the more simpler of the two, which basically applying using the prior year chargeable income and applying the formula for each quarter. So you can get a fixed amount each quarter. This one is pretty straightforward, but the method B is based on actual figures for the quarter. For example, you have a quarter ended for March 2023. You will need the profit and loss for that quarter to be able to calculate your tax liability for that quarter and file a return 3 months down the line. Then if it's a March 2023, then the deadline will be end of June 2023. COVID-19 levy, basically, if you had taken the popular government wage assistance scheme and you are in a taxable situation, a taxable profit, you will have to pay back the COVID-19. You have to pay back the GWAS, the government wage assistance scheme, in the form of the COVID-19 levy. How does it work? So in the tax return, you will see it's populated in item 81A, and here you have to be very careful, because we have seen situations where this amount, which has automatically been populated in the tax return, or either MNS or on the MRA website, this amount differ from the client's accounts. So there's a slight difference, which at the end can impact your tax liability. So you have to be careful to use the right amount. So make sure that you open the tax return on the MNS to cross-check the figure. If taken the right figure. Where the employer is a resident company, the levy shall be equivalent to how, basically, this is how we calculate it. Either you take the total amount paid under the wage assistance scheme, or 15% of the chargeable income, whichever is lower. So whichever amount is lower of the two, then you take whichever is lower. But if you have a tax loss for the year, you don't have the requirement to pay the COVID-19 levy. Coming to our last slide, which is the penalties and interest. So basically, this can be summarized in the table where you have the applicable penalties. For example, for penalties for late submission of tax return, this is 2,000 rupees for the month or part of the month for a maximum of 20,000 rupees. The penalty for late payment of tax, 5% of the tax liability, interest on unpaid tax, 0.5% for the month or part of the month the tax remains unpaid. A penalty for loss overclaim, this is 5% of the loss overclaim, which will be offset against the amount of loss to be carried forward. And you have the penalty on the income tax refund that is overclaim, which is up to 25% of the amount of the excess refund overclaim. We have reached the end of our webinar. I hope that you have found it very useful and helpful. So going forward, that will help you, hopefully. Bobby, if you have nothing to add, I think we can move to the questions.
Yes, thank you, Jayesh. So to all the attendees, I've already answered a few questions where attendees have been IM me directly. So the time now is for questions. So we wait for your questions in the chat box. In the meantime, one of the questions raised was related to the bank revaluation at year end. So based on the Supreme Court judgment, so it has said bank revaluation at year end is considered to be capital in nature, so the gain will not be subject to tax. Obviously, the losses will not be allowable. I think I've got one question.
Bobby, we have one question on the TDS section.
Okay, if you can go back to the slide
to the
of TDS.
Yeah. Yes, in terms of TDS, okay, we may shed some light on the TDS and the rates applicable. Well, you have interest. So interest is applicable at 15%. So you'll be in a situation where global businesses are exempt from these types of interest. If they have to make an interest payment to another company, a foreign, let's say a foreign a related party, they won't have to pay the 15% because in the tax in the second schedule of the Income Tax Act, they are exempted from that, provided that they pay out of their foreign source income. And you have the royalties payable to resident and non-resident, which is self-explanatory, and the rent as well. Payment to contractors and subcontractors, which is 0.75%. And of course, the payment to providers of services. And you have the list of services: accountants, architects, attorney solicitor, barrister, engineer, land surveyor, legal consultant, medical service provider, project manager, property valuer, quantity surveyor, tax advisor, or his representative. Bobby, if you feel you will have to add anything else on the TDS section.
I mean, in terms of TDS, so the sixth schedule is quite explicit in terms of the percentage that should be withheld. Now, reference should also be made whether it's a non-resident, it's a resident, and most importantly, the double tax agreement in existence. So sometimes there could be a rate which is applicable in the domestic law, and then the rate in the DTA is different. Secondly, depending on the taxing right that has been allocated in the DTAs, we should be very, very careful before applying the TDS rate. You could be having like a sports person coming in Mauritius, so we should have a look at the DTA before applying the rate. We've got some more questions here, if I can start to answer them. So one of the questions is it relates to the election of on a realized basis. So the question is, when we say yes, do we need to reverse the unrealized losses and gains? Yes, that's the main issue with the election when it comes to realized basis. So all folks which are unrealized could be either deducted or added back, obviously reverse when it becomes realized. This is quite painful because depending on the number of transactions that the company might have, it becomes really a headache at month's end and obviously at year end to get all these items in place. I mean, what amount relates to which have been unrealized and have now been realized. So it's a real headache. But yes, to answer the question, we need to reverse, of course, when it's realized. The next question is if a GPL have both foreign and domestic source income? I guess the question is about the way that the tax is calculated. I think we showed it in one of our slides. If the normally the global business company would be deriving foreign source income, and it's very likely that the GBC would be subject to tax at 3% based on the fact that they will enjoy the 80% partial exemption. But if they are not entitled to the partial exemption or even foreign tax credit, then they are subject to tax at 15%. So if the GBL have both foreign, but of course, domestic source income is subject to tax at 15%. That's clear. The next one is if a company which has some ENVT, I don't know what does that mean, but starts to buy and shares investment. Okay, investment, but starts to buy and share the shares in a period of less than 6 months. Yes, we had a statement of practice at some sort of a letter sometimes back, but this has been revoked. So the question is whether the company is actually dealing, in the buying and selling of shares, or whether it is capital in nature. Anyway, the gain, when we look at the Income Tax Act, the gain on the buying and selling of shares are exempt from tax. But this issue of 6 months has been, it no longer appears on the website of the MR. It's no longer used.
Sorry, Bobby. I still have a question. TDS between two domestic companies. Between two domestic companies, there's no TDS applicable. So you don't have TDS in regards to transaction between one resident company to another. It's only applicable to non-residents.
One question on TDS, Jayesh, we could see company providing consultancy. So maybe it's on the next slide, Jayesh.
Yes,
I think the rate has changed. So it's 3%.
Yeah.
But is it for audit? Does it mention auditors here? Can we have a look at the fifth schedule? The previous slide, Jayesh, accounting firms, then it would be 5%. Because if it's for audit, it's 5%. If it's term consultancy, then it's 3%. That would answer the question whether 5 or 3%. The next one is year one turnover is greater than 6 million. TDS is deducted, but year two less than 6 million should be deducted from the fact that. No, it will depend on the turnover in the income year in which it's applicable. So if it falls below the 6 million, obviously the TDS should not be applied, right? TDS is applicable to GBL payers, and if the GBL has both foreign and domestic source income, how does the TDS apply? Yes, a GBL has the obligation to withhold TDS as well, because we've got issues like, for example, global business companies renting parking, so they've got to retain TDS.
Yes.
Should TDS be deducted? There's a lot of questions relating to TDS today. So when payment being made by DC to management.
Actually, I think we should do training on TDS.
Yeah. So TDS deducted when payment being made by GBC to MC. So
yes, this will fall into category of no think there's for management companies specifically. No, depending on the service being provided by the management company.
Yeah. If a company has elected to be taxed on an unrealized, still needs to disallow the foreign bank account being of capital. However, what about unrealized gain on revaluation on? Yes. So even if a company has chosen to be taxed on a realized basis, when it comes to revaluation of bank account, so I'm just relying on the court judgment Sotravic, which says that this is capital in nature. So capital in nature will remain capital in nature, even if a company has elected to be taxed on a realized basis. When it comes to revaluation of bank accounts at year end, So this is basically either a gain which would be considered capital in nature, so it should not be taxed, and if they are losses, it should not be deducted. So do we have more questions? We have a few more minutes.
Yeah.
Why only bank account? It would be short-term nature as well compared to that. Yes, that's a good discussion. Why is it on bank account? So there has been, formally, the MRA was taxing the gain on revaluation of bank account. So when there were gains, these were subject to tax, especially now with the value of USD vis-à-vis the rupee. And then with the Sotravic case, then now we can say it's capital in nature. So the gain will not be taxed and the losses will not be allowed. There's one question I have missed your answer with regards to forex on realized basis. So let me explain that maybe once again. There is an election to be made to be taxed whether on a realized basis or a traditional basis. So realized basis is only when the gains are realized. So unrealized gain and unrealized losses, gains should not be subject to tax. So it should be deducted in the tax computation, and unrealized losses should not be allowed. It's only when they are realized, then they will be the gain will be taxed or the losses will be allowed. Now, if a company has chosen the realized basis, the revaluation of bank account at year end being capital in nature, so will remain capital in nature, regardless of whether it is traditional or a realized basis. So that's what I want to mention. But feel free to call me on my mobile or send me a mail if you would like to have.
You can always send us an email if you require more details. The next question from Zainab is: suppose MC providing accounting service to GBC, should TDS be deducted? So it will depend on the service. So as you can see, accountant, then yes, the TDS should be deducted.
Okay, I would suggest Zainab to send us a mail with more details. We will more than happy to assist you on that.
Yeah.
Yes. So the next question is brief us on again on tax lapse after 5 years. So yes, the law provide that tax losses could be carried forward for 5 years and it should be lapsed. So with the examples that Jayesh mentioned earlier, we should make sure in which year the loss has arisen and what would be the fifth year the loss should be lapsed. In the event the loss is not lapsed, so it will be carried forward, and this is where the MRA could impose penalties on excess losses carried forward. So this is provided in the law. So can the election from realized be changed? Unfortunately, is this if we refer to the law, it's irrevocable. Excuse me. So cannot be revoked. So once an election has been made, we should follow the law. But we've never tried to test this. I think maybe a correspondence should be sent to the MRA giving valid reasons why this would be changed. I guess that they would accept.
I think they might be flexible if you have valid reason for it. Yeah.
Oh no, we're gone. So thank you so much. If you've got any question, please send us a mail. We will be more than happy to send you our reply. So maybe one last question which we can take. Yeah. Where should directors' fees bill to close be disclosed in tax return? Directors and minimums. Where should it be disclosed in the tax return, Jayesh?
For accuracy, it's better you disclose it in directors' emoluments, but it's not a major problem if you disclose in legal professional fees. But for clarity, if MRA request for a breakdown, if it's a situation where they request for some breakdowns and they see directors' fees, then they might tell you to reclassify it. But I don't think this would be a major issue. But you need to make sure that the appropriate tax are being withheld on the directors' emoluments.
Yes, and directors' fees are subject to PAYE at the rate of 15%. And for non-resident directors, especially for MCs, so for non-resident directors, it's 15%, and you could refer to the Income Tax Act. It's as if the person has filed a return. So it's 15%, and that's it. That's the final tax paid by the person. That's why for directors' fees, it's 15%. So there is a tendency for people to move to directors' fees because of the CSG. So
CSG.
yeah, because of CSG, people are moving toward directors' fees instead of emoluments. So this is a different debate we can have maybe separately. Maybe we'll take one last question is whether
Yes.
provision should be allowed. Yes, this is in accordance with unauthorized deduction section 26. Provisions should be added back in tax computation, but from an accounting purposes, we've seen, for example, for a prescribed bonus, it's provided from an accounting perspective, and there is certainty for that provision to be paid. There have been instances where the MRA has accepted it because this is something which is mandatorily paid. So from an accounting perspective, it is provided in the financial statement. But provision itself, it's clear-cut under sections 26 of the Income Tax Act. It should be added back in the tax computation.
Yes, just to add up on this, you have to make sure that it's actually a provision, not an accrual. So accruals are allowable because we prepare tax computation on an accrual basis. So provisions, sometimes that clients, accountants put it as provisions. They should be when in reality it is accruals. So you need to make the clear distinction between the provision and an accrual. Provisions, no questions, they have to be disallowed. And accruals, they can be allowed, yes.
Okay, so this brings us to an end of this webinar. I'll take this opportunity to thank you all for your time. We'd like to thank Jayesh, Liane, and Elsa, who have given us a very great help at the back. They are our marketing team. Thank you, everyone, and hope to see you in our next webinar. Have a nice evening.
Thank you, everyone.
Bye-bye.
Bye-bye. Bye-bye. Thank you. Have a nice day.